So to talk more about the markets, I do want to bring in our markets guest, Sam Stovall. He's a chief investment strategist at CFRA Research. Sam, always good to see you. I know you have a lot of data that you come to these interviews equipped with, and based on where the market is trading now, what we saw in January, what should our viewers know?
Good morning, Kristen. Good to talk to you again. Well, January is a very good barometer, if you will, for the entire year. You can learn more about it at the Stock Traders Almanac. But essentially, the old adage is, as goes January, so goes the year. Especially in year one of the four-year presidential cycle. In that case, the market has gained more than 18% on average and has risen in price 91% of the time. So that's a good indicator, but obviously not a guarantee. And then you can add to that February. If this month does end up being positive as well, then essentially 97% of all full years were positive. Only 2011 slipped by 0.002%. So you could essentially say that all years except one were up.
What should investors make of the recent choppiness, though, Sam?
Well, I think that choppiness will be the key word for the year. When you look to year one of presidential cycles, about 90% of them had market declines of 5% or more, with the average being about 17%. I think investors are scratching their heads as it relates to tariffs. Are they still more bluster than bite? Are they still a negotiating ploy? Because let's face it, we got 30-day stays of execution for Mexico, Canada, China. Now with the threat of steel and aluminum tariffs, that too is a concern, although those groups represent a tiny fraction of the market cap of the S&P 500.
Of course, we've seen a wave of announcements come out of this new administration and a red sweep, in fact, in D.C. What is the right way to ingest that and respond to it, knowing that government cuts, we've already seen them, certainly in place?
Well, that's what the Republicans ran on, was to trim the expenses of government, and that's what they are attempting to do at this point. So I think what you basically have to do is not fight it, but sort of work with it. And that's what I believe investors tend to do. So essentially, realizing where cuts are likely to be found, where tariffs are likely to take the biggest bite, etc. So even though consumer discretionary was one of the three best performing sectors in 2024, and history says after an up year, you want to let your winners ride. So communication services, technology, financials, and consumer discretionary were the top performers. You might want to keep discretionary on the side because that's likely to be one of the sectors most heavily hit by tariffs.
February historically is one of the more volatile months on the calendar year. What do we typically see in February, and do you think that could pan out this year?
Well, February is the second worst month of the year for the S&P 500, going back to 1945, posting an average decline. The good news is that it has, like a coin toss, however, risen a little more frequently than it has fallen. September is the worst month with the deepest average decline, and it fell more frequently than it rose. Yet a down February does not guarantee a down year. Actually, the market has risen about 2.5% after a down February and was higher 54% of the time. But the nice indicator would be if we got a positive return, as I mentioned before, in both January and February.
And in terms of earnings, Sam, they continue to come in. We've heard from most of the Mag 7 companies. NVIDIA usually is the late reporter. What are your takeaways from this earnings season so far?
Well, management, once again, has done an excellent job of managing expectations. I say that because 9 of the 11 sectors have seen upward revisions to earnings estimates that were in place as of December 31st. Instead of getting an 8.7% rise, according to S&P Capital IQ estimates, Now we're likely to see a 13.7% increase, so a 500 basis point outperformance, which will probably make this the 61st of the last 63 quarters in which actual results have exceeded end of quarter estimates. And technology is expected to post about an 18% year on year increase in earnings this quarter versus the sub 14% for the market.
Sam, we did see the markets take a turn lower on Friday in the wake of the consumer sentiment report, seeing a full percentage point increase in inflation. In fact, how important is that report and what we saw in its contents?
Well, I think a lot of the things that we've been experiencing over the last couple of days have been important. Yes, consumer confidence. Yes, gold prices, because they are reflective of the concern regarding inflation and whether the Fed will indeed be slower to lower interest rates. This year, we're still expecting two rate cuts, one in the second quarter and one in the fourth quarter. But there is definitely a possibility that we end up with only one or none. So I think that is a concern. So we're in the third year of a bull market, and third years are typically very challenging. And so I would not be surprised if we do not, like the Kansas City Chiefs, have a three-peat, meaning three successive years of double-digit gains.
Wow.
History says that happens only about 1 in 5 times, with the average third-year gain being around 5%.
All right, we will be watching closely. Sam, always appreciate your insight and, of course, data that you bring to the table. That is Sam Stovall. He's the Chief Investment Strategist at CFRA Research.